Good afternoon, everyone, and welcome to BDO's webinar this afternoon. I'm Paul Rafton. I'm the superannuation partner for BDO here in Brisbane. And today I'm joined by Guy Taylor. Guy is one of our partners in our private wealth division, who's also based here in Brisbane. Today, Guy will cover off on what he's seeing in a broad investment sense, and he'll also give us some insight into what he thinks might lie ahead for investors. I'll then take us through some more specific areas of the stimulus and how they relate to superannuation. We will, of course, have time at the end for questions, but please type them into the question box if you feel you need to as we go, and we'll hold them off until the end. Just a reminder that this webinar will be recorded and will be distributed within 24 hours. And also, please keep your eye out for future BDO webinars. For example, later on this week, Mark Molesworth, our tax partner, will be providing a deep dive into the new legislation in his webinar. For now, I'll hand over to Guy to take us through his investment insights. Thanks, Guy.
Thank you, Paul, and thank you everyone for joining us. So just a quick reminder as a first point of call, as this is a private wealth update, it is general information in its nature, and nothing should or can be taken as a personal recommendation. If you are seeking additional advice that applies to you personally, please reach out afterwards. We'd be happy to have that discussion. So first and foremost, I think everyone's obviously listening and hearing the stories of what's happening in the world, and there's a huge amount of information that's coming through. I'm going to try not to go too detailed into the information about the COVID-19 health issues, but it does need to be addressed because obviously that's where these financial impacts have stemmed from. And this is unprecedented times in terms of the impact and what has happened in a very short space of time, of which we're on the fly making these slides because the information that's coming to hand is moving that quickly. So first and foremost, this has really started as a health issue, being the coronavirus that has now spread globally around the world. Governments have acted to try and stem the contagion effect of that virus, and that's really been through the use of a few tools that are in the armory. Really, the biggest things are restricting movements, so that's to try and lower the spread. Then tracing and tracking every infection, so basically test cases of looking at, well, who does and who doesn't, and how do we quarantine those people. And then the third step, which we're now seeing in large parts of the globe, is a total shutdown, except for obviously essential services such as your hospitals and your need to go to the grocery store, etc. But effectively, the health and the economic impact work hand in hand. If you go too far on one side, you're going to have too much of an impact on the other. So governments and policymakers around the world really have one job, and that's to make sure that that health impact is not sort of bearing the full brunt, where hospitals are being overwhelmed and overloaded, where then our medical specialists are needing to make choices about who does and who doesn't go into ICU and get the ventilators. So that's then meant that swift action has happened around the world to try and limit the spread, or flatten the curve, as they say, which that has then had dire economic impacts to obviously businesses and economies as a whole. We're now seeing governments going through a range of stimulatory measures to try and shore up some of those, or stem some of those impacts that they've had. So the first part that I want to look at really is looking at flattening the curve, because this is what's having a direct impact onto the economic side of things. So you can see in this graph here that there's a number of countries which have actually done quite well at being able to manage the spread and flatten the curve. So places like South Korea, which has had one of the highest testing rates, and they got on top of it very quickly. Japan, Singapore, and Hong Kong, they've all done very well at sort of stemming the spread. And also China has done very well at sort of getting on top of it, looking at the figures that are coming out from there. You can see a number of other European and now the US are really struggling with keeping on top of this. They haven't been able to take those measures as quickly. And the benefit of being here in Australia, being an island, and also being in the Southern Hemisphere, we've been able to watch and see what's unfolded in the Northern Hemisphere. So we're sort of probably 3 weeks behind that sort of curve, and we've been able to have measures put in place pretty quickly. That hopefully means that we're on top of it from a spread, which means that our hospitals won't be inundated, and obviously that's been those measures where we've seen pretty much everything short of total lockdown in our country. So that has obviously had some huge economic impacts, shutting down pretty much everything across the country. It's meant huge job losses, and now it's looking like it's going to flow through to other parts of the economy, depending on how long these shutdowns last for. So going through what the government's trying to do to shore up our economy here in Australia, we've had 3 significant stimulus packages announced over the last 2 to 3 weeks. So those 3 packages now total $320 billion across the forward estimates, which represents 16.4% of our annual GDP here in Australia. If we look at what that means from a global sense, other countries have taken similar stimulus measures to try and shore up the economy and keep people employed. What we're looking at here is the world's biggest economy is still by far the United States in GDP figures. They're sitting there at just shy of $22 trillion in their total GDP figure. And you got to remember that the US is going into this at a balance sheet debt to GDP ratio, which was already extended at 110% of debt to GDP. So they already had a significant amount of debt going into this. They've announced stimulatory measures with record amounts. That $2 trillion package that was announced last week by Trump, that has done some good things for markets, and there's been quite a strong rally over the last week in US and global markets. The good news here in Australia with our GDP figures, our GDP is just shy of $2 trillion per year. And the stimulatory measures, as I said before, about 16.4%. So huge numbers being thrown at this to try and stem the impact from the shutdowns. What we're looking at now with those stimulatory measures is really how long will this last? And the government's really just trying to build a bridge to get us through that latest package that was just announced yesterday, that the government's looking to support employers, keeping employees on their books and riding through this is really a 6-month measure to try and keep everyone in place, ready for when the recovery comes, that it's not then just a dire situation of having to start from scratch. It means people have been effectively in hibernation or sitting on the sidelines, so they're ready to go and get back out there. So what we're seeing and hearing, we're obviously getting a huge amount of information and data flow coming through from various sources. As I said before, this is unprecedented situation, and really there's nothing to compare to. Whilst markets do go through cycles, and we've seen similar sell-offs in equity markets in the GFC and .com and 87 crash and all of those things, this is very different in that we're seeing it being a government response to shut things down as to where the issues are now coming from and the flow-on effects and what that then means for the economy. So just to give you an example, I did a webinar last week on Wednesday where I had a number of slides, and all of those slides are now irrelevant, that just in the short space of 1 week, the data has moved significantly based on a number of different factors. So the biggest thing for us is making sure that we're getting information from trusted sources and we're reading the actual facts. There's a lot of news and there's a lot of social media things out there at the moment which would effectively lead you to believe some stories which may or may not be true. So fact checking is definitely a big part of what you should be doing before you act on some of the information you're reading or seeing. How we're reacting for clients, we're very much taking a disciplined approach to this. We've built very well diversified, robust client portfolios that have been able to ride through this, that have benefited from not only the investment selection and choice, but also holding a strategy. And I think a lot of people in these sort of sell-offs do look at the short term and think, geez, the world's going to end. Maybe I should be moving to sell out or do something very quickly or rationally. And I'd take warning against people that are thinking of doing those things, because how quickly the markets are moving at the moment. Bear in mind that the market's been through a number of corrections of similar sort of magnitude in terms of sell-offs in the past. It's just this is not known as to when that recovery is going to come. But just to give you a snapshot of what's happened over the last month, markets before this crisis unfolded were hitting all-time highs. This chart here is showing where the ASX All Ordinaries Index was, which points out at the 20th of February, the All Ords were sitting at 7,255 points. And then very short and sharp over a month period, it was down 37.1%. A lot of stimulatory measures that were announced have then obviously buoyed markets, and people have been getting back in. That's meant that we've already seen a rally of 16.3% just in the last week alone. So again, for those that were trying to time and get out and get back in and all of those things, had they missed some of that recovery, there would have been some, I guess, concerns on how they're investing. So learning from the past, what we can see is those that do stick to a strategy are the ones that are awarded over the longer term. So this chart here then talks you through the GFC and talks a little bit about the psychology of investors and how they've seen and reacted in markets of similar sell-offs in the past. Looking at this through the period of 2008, 2009, there was a big sell-off. There were a number of investors that didn't bear the warnings to stick into their strategy, and they sold out thinking, that's great, I've not had to bear the full brunt of the downside. But an equally big risk is that you don't get back in time to pick up on the rally that inevitably will follow. As this chart then points out, is that there will be, or as there was in the GFC, there was a recovery that came out, and those that did sell out very rarely were able to time the opportunity to get back in to benefit from that upside. As I said, there's going to be some questions that we can answer at the end. I'll let people put those into the comments bar. But just to give you more sort of off the cuff, anecdotally sort of updates on what we're seeing and hearing out there in markets, I've had a number of friends and family reach out to me and looking at, what should I do? Should I be selling out my super? Should I be taking money out of the bank? Should I be doing this or that? The biggest thing through this is it's probably already too far gone that the markets have sold off significantly. That's not to say that markets aren't going to sell off further over the coming months. There's no crystal ball. No one knows exactly what's going to happen in the coming months ahead. I would say as Australia, we're a very lucky country in that we've been able to at least take some actions, and hopefully we'll avoid the full brunt of what some of our Northern Hemisphere countries have seen before us, and manage our way through this. It's really about making sure that you've got a disciplined approach to it and a well thought out strategy rather than just making off the cuff decisions. Certainly we'd be happy to have discussions and have a look in how that applies to your own personal situations if you did want to get in touch following the webinar. On that point, I'll hand over to Paul, who is going to run us through some of the technical updates of what's now been announced from the government, and he'll talk us through some of those measures that you might want to have a look at.
Thanks, Guy. Next slide, please, mate. Okay, so what I'll cover off on is the changes to the minimum pension payments and what that might and the impact that has from a practical point of view on self-funded retirees that have a self-managed super fund. We've got a number of clients with self-managed funds that have a direct property investment and generally will have a related party tenant. And then I'll just also talk about the COVID-19 early access to super and how that can be accessed, and some trips and traps that might relate as well. Thanks, Guy. So these new measures are temporary, and they have received royal assent on the 24th of March. So they are now law, and Parliament is now in recess until August. So first up, we'll talk about some pensions and some ideas around what that looks like. So the minimum pension requirement has been halved for the remainder of this financial year and through to 30 June 2021. There's been no change to the maximum pension withdrawal. So if you're in a transition to retirement income stream, that maximum is still 10%. If you're in an account-based pension, that maximum amount is still your account balance. And if you're in a market-linked pension, that maximum amount will be based, of course, on a formula method. So here's a table here that sets out what the old factors were. Quite simply, 4% is now 2, 14% is 7, if you're lucky enough to be around at 95. Thanks, Guy. So as I said earlier, the reduction applies to, just back one, relates to account-based pensions, market-linked pensions, and transition to retirement pensions. It does not apply to complying lifetime pensions or life expectancy pensions or flexi pensions. Those kind of pensions are pretty old legacy type pensions, and we don't see many around, but there still are some. So I'm pretty sure if you were in one of those old legacy type pensions, you'd know about it, and it's important to reach out to your advisor and see what they suggest you could do around this circumstance. Thanks, Guy. So here's an example of Sam, who has a minimum pension under the old rules of $19,110. A simple calculation at 15% gets you to $9,555. The trick here is to remember that we need to round that amount up to the nearest $10. So that means the minimum pension payment is not really $9,555, but $9,560. Now, why is that important? That's because the minimum pension standards require that rounding take place. Where a pension is underpaid by even $1, it would cause the fund to not have met its minimum pension payment requirements and could jeopardize the tax exempt status of the fund. There is a one-off relaxation where if you draw less than 1/12 of the minimum pension, you can use discretion and treat the fund as though it had met the regs. The important part is to remember that you really wouldn't want to have to apply that one-off get out of jail over a $5 rounding error. So just be on top of that and make sure that rounding is followed with your own fund, or if you're giving advice around funds, make sure that you're mindful of that. We take that a bit further in Sam's circumstance. If he's already paid his $19,110 already before 30 June and before the stimulus was announced, then he doesn't have to do any more. He's already met his minimum pension repayment. It's basically he doesn't have to take any more payments. If Sam has only paid $8,000 so far, he'll only need to pay another $1,560 to get him to his new minimum. In the case where Sam has already paid, for instance, $50,000, again, he doesn't have to pay any more, but he can't repay that excess back into his super fund unless he's able to do so under the contribution rules. So he would be needing to look at that and seek advice around whether it's appropriate to put the excess amount back into super. For our clients, we'll be looking at providing new calculations and some supporting documents. I think that the thing to bear in mind around these announcements, and we're all seeing Scott Morrison on TV making some really great announcements, but at the end of the day, the ATO are the regulators of superannuation funds, self-managed funds particularly, and they're going to be looking for evidence, and they're going to be looking for documentation to make sure that trustees have made timely and appropriate decisions. And I don't want to scaremonger, but it's really important that those decisions are made upfront and documented rather than getting to the stage where you've got the fund and it will be potentially 18 months time where you're putting your fund to audit for the 2020 year and you're scrambling to find some documents and remember what decisions you made today because of all of the COVID-19 stuff that's going on. I know it's a busy time and everyone's scrambling to get everything done and stay on top of everything. But it's important that these things are done properly. Over to direct property. We have a number of self-managed super funds where they have a direct property within their super fund. My understanding is that it will also extend to an underlying unit trust. So where a fund is the owner of a related unit trust and that unit trust owns a property that's leased to a related party, the same rules will apply. What the ATO have come out and said is that they won't undertake any compliance action where a super fund has provided a tenant with rent relief. Now, they've also said that it has to be in direct response to COVID, it has to be necessary, and it must be temporary. So where you've got a business where they haven't been impacted by COVID, and there are some that haven't been impacted by the COVID disaster, then they won't be able to provide a rent relief to their tenants. Now, it's not a free-for-all, and it's really important to make sure that the rent relief that a self-managed super fund is providing as a landlord is measured and can be justified to the fund's auditor in due course, and then ultimately to the tax office. So it doesn't alter the existing rights or obligations to the landlord or the tenant either. So it's purely a relaxation around the amount of rent they pay. There may be an expectation that rent relief will be repaid or caught up at some future point. In our view, the tenant should request the rent relief in writing and document the reasons why they've been affected by COVID. That's pretty important. So clearly, if they're a coffee shop, you know, that although I think all they need, in my view, is to say they're a coffee shop and they've been impacted 100%, they've had to close down, and they would apply to their related party landlord to have a reduction in their rent. However, if it were a practice, maybe a pharmacy that, while they've certainly been impacted, they're still, you know, busy, perhaps busier. So a landlord of a pharmacy would probably have to provide a whole lot more rigor around providing rent relief to a related party tenant. Can we just flick back to that slide just for 1 minute, please, Guy? Yeah, and then it's important also to get the landlord, being the self-managed super fund, to agree to the rent relief. So that's all documented and tidied away. And then the trustee of the self-managed fund ought to put together a minute just documenting the decisions they're making during the course of the next week or so around how they came to it. They don't need to go to market and get a market valuation. I think that's a good measure from the ATO, in that they're saying as long as those other criteria are met, they're not going to be looking for landlords, as in self-managed super funds, to be coming up with a valuation. It's pretty impossible. I think at this stage, as Guy said earlier, it's a moving feast, and property values and circumstances changing every day or every couple of hours at least. So devil's in the detail. In terms of accessing super early, again, this is one where the detail needs to be peeled away a bit. So what it's COVID-19 early access is saying is that for this financial year and next financial year, an individual who is affected can access $10,000. The $10,000 this year has to obviously be before 1 July 2020. And then for next year, the offer that's on the table at the moment to access super lapses on the 24th of September. So there's a bit of a not quite a 3-month window there if someone's affected. So there's some warnings here around accessing super without it being properly authorised. The ATO will take the view that it's still illegal early access, and will apply the full rigour of the law. So it's important that anyone who's planning on accessing the super goes through the due process. And I know that for trustees of self-managed super funds, that may seem easier because effectively they control the bank account of the super fund, but they need to bear in mind that the ATO, as in Big Brother, will be watching, and they need to follow all of the right steps. So what are the requirements? An individual to access their super has to be unemployed, or a job, or undertaking a job seeker payment, which is of course the old New Start. Or for employees, they have to have been made redundant after 1 January 2020, or their working hours reduced by 20% or more. This is one that almost caught me out. Well, it did catch me out earlier in the week. And again, it's talking about the reduction in working hours, not the reduction in salary. So if, for instance, an employee had their hours reduced, but their salary maintains, then I don't believe that they can benefit from the early access to super requirements. Again, for a self-employed or a sole trader, if their business has been suspended, or in Scott Morrison's terminology, gone into hibernation, or they've experienced a reduction in turnover by 20% or more. So a lot of our clients are asking, how do they calculate that turnover reduction? And it's calculated by comparing the average of the last 3 months of last calendar year to the current period. So from 1 July 19 to 31 December, and then comparing that to the current period to see whether there has been a reduction. How to apply? The good news is that we can all apply for this if we qualify via MyGov. And the actual application will go live from mid-April, I'm led to believe. You can submit now an expression of interest. The ATO will be solely responsible for administering the process all the way through to payment, and it requires an individual to self-certify. Now, it seems pretty easy, but what the ATO will be looking for, and when you go in there to even access the expression of interest, is you have to give certain undertakings. So it's important for anyone who thinks that they qualify to make sure that they actually do, and that they don't make any false or misleading statements. So for the ATO, for a self-managed super fund, originally it was going to be via a different channel that a member of a self-managed fund could access their super early, but that is now going to be via the MyGov process as well. The ATO will provide the release authority for a member of a self-managed fund to the member. The member will then provide a copy of that release authority to the fund trustee. And then once the fund trustee has received that release authority, they can make the payment. So just remember that you cannot make the payment until the member provides the fund with a copy of the ATO's release authority. Don't be tempted to jump in early and think, well, I've made the application, I can now do it. Got to follow the process. Apparently it's going to be a pretty quick turnaround. So the government, of course, are keen to get this out where it's appropriate without a whole lot of delay. For members of other funds, we call them APRA regulated funds. You might know them as industry or retail funds, the likes of Sun Super, AMP, the old bank super funds and the like. The process is similar. You go through the MyGov site. The ATO will provide the release authority, in this case, directly to the superannuation fund. And that fund will make the payment directly to the individual. So they won't be contacting, there won't be that layer of the ATO contacting the individual. The correspondence will all take place between the ATO and the APRA regulated superannuation fund. So anyone who's thinking about accessing their super early and they're a member of an industry or retail fund, they should have a look at working with their super fund and making sure that all of their personal details are up to date, including their contact details and their bank account details, so that when the payment's made, it gets to where it needs to go. So some questions that we've fielded in the last day or so just from our clients was around the idea of, one of our clients is, what if I apply for $3,000 now and then I find out I need another $3,000 before 30 June? The way the rules apply is that it's a once only application process. So you need to assess how much you think you'll need and make the application. If you only apply for $3,000 now, you don't get another bite of the cherry before 30 June. What if I apply for $10,000 now and realize I only needed $3,000? Can I return $7,000 to my super fund? The answer is no, unless you meet one of the usual contribution conditions. So that And obviously this all, and Guy will comment about this after I've finished, but what it means really is that, you know, the time value of money in terms of whether you take that money out now and what that impact will be upon your superannuation fund for the long term. So in my view, you'd only access that your super as a really last-ditch effort, and go through some of the other measures that the government are making available, as well as talking to banks and creditors and things like that to see if you can hold off on touching your super. So that was the end of my presentation, and while I was preparing the slides last night, I had my music on in the background, and Monty Python's Always Look on the Bright Side of Life came up, so it seemed appropriate given the current circumstances. So I think that's what we all need to do. So thanks for listening, everyone. We do have a number of questions that have come through. Some of them around not being able to hear us, but otherwise, I'll start with the questions we've received ahead of time. And one of them was around, how does the extra drawdown from super due to financial hardship count towards the annual cap? Not quite sure what that means there, other than that the withdrawal from super won't count towards any of the other areas around Centrelink or those kind of things. So it won't. It's a tax-free withdrawal from your super, and it won't impact any of your other benefits or count towards the caps for those benefits. Another question was here, how does it affect the super for a younger population? Can younger people take out their super, and what is your advice for the investment strategy in this situation? Guy, do you want to talk to that one?
Yeah, I might talk to that one. That's relates to what you were saying before about the time value of money. Certainly, we understand these measures have been made to assist people coming through. And I think when I look at this policy, this was sort of part of the second round of stimulus, which then have subsequently come out and hopefully shored up some of those jobs with the JobKeeper payments. Because my advice really would be around, superannuation really is a long-term, it's meant for your retirement. So if it can be avoided drawing on it, that's my advice, because of that time value of money. If you pull out 10,000 today and 10,000 next financial year, 20,000 in total, and you're a younger superannuation member, you're forgoing the future value of that money, which could sit in super for another 20 or 30 years and compound away. And you could be giving up, you know, fourfold in terms of what the future value of those funds might be.
Perfect. Here's another one for you, Guy. How long before the equity markets will recover?
That's a little bit like how long's a piece of string at the moment. As I showed in my slides, equity markets somewhat did recover. The Dow Jones was up over 20% last week alone. But I certainly am not saying that that's the end of this. I think there's going to be a lot more volatility that should be expected over the coming months. It'll be a combination of continued spread and contagion, and sadly, more people passing, unfortunately. That's obviously going to drive further fear. That's going to mean governments need to lock things down for a longer, extended period of time. But there is some really good news on the other side, that we're seeing some good news stories out of researchers and, you know, clients of the medical space that are on various boards or research committees around the hospitals, that some existing antiviral drugs are having some positive impacts. They're working through how that may work, and that could mean the difference from turning up at the hospital and, you know, on one hand going into ICU, and on the other hand taking a few tablets, and turning around and going home a couple of days later and not having to go through the worst of it. So that's really positive. Longer term, looking out, then there will hopefully be some sort of vaccine at some point. You know, never in the history of the world has there been so many people trying to work on a cure for one thing as there is at the moment, from what we're hearing. Whether that sort of comes through or not, and the time frame of that is yet to be determined. But certainly, yeah, you've got to look at this and sort of see that the measures that are being taken at the moment are really about trying to get on top of this thing first and foremost, to prevent that spread, to try and make sure hospitals aren't inundated, which then tries to save as many lives as we can and protect those that are the more vulnerable people in society. And that's obviously the right thing to do, and that should be the focus at the moment. But there will be opportunity that comes out of this. There's going to be, given the amount of stimulus that's been thrown at it, there will be a recovery at some point when we get through the worst of the spread. And it's just a matter of, is that going to be 3 months, 6 months, 12 months, who knows? Watch this space. There'll be more updates on that as we go through this. One other question that I can see there in the pre-questions was about, should I be transferring from my SMSF to an industry fund? That's something that we do get asked a lot, and another thing that I'd question as to, really, you need to look and seek some personal advice around that, because everyone is going to be different in their time, whether you're a 30-year-old or a 60-year-old, or whether you're invested in growth assets such as all shares and property, or if you hold some defensive assets as cash and fixed interest as well. But also, I think there's a really important thing to consider there around that asset mix is listed or unlisted. Paul spoke before about a number of SMSFs that have direct property holdings. There'd be an investment strategy around that as to why they're holding a particular investment in a self-managed fund. Most of the time that's very much related to their business. But I'd have a look and be cautious about some of the funds as well out there, depending on where you're rolling to. Because of these early access measures, a lot of the industry funds, I think, might come under a bit of strain as well from a number of, particularly those big ones where there's large scale unemployment measures seen in the hospitality or retail side of things, which they now might be lining up to get their 10,000 or 20,000 out of their super funds. Because all of these super funds, the trustees have made decisions to invest for a long-term period, and they're usually doing that looking at their group of members and making a decision based on what's best for their members, not anticipating that the government would very quickly change the rules and say, well, hang on, now you can go and access your 10 or 20,000. That could potentially have some real profound impacts from those funds that are holding higher weightings to unlisted assets, be it properties or infrastructure or private equity type businesses. And not just those withdrawing, but also those that are just have already or are likely to switch from the usual sort of default sort of balance type profile back to cash. And there's some pretty interesting statistics on that, those that are unadvised are the ones that are making those moves, whereas in the statistics we're seeing from those that are taking advice and under an advice relationship, they're much better suited and able to navigate these sort of uncertain times.
Good. There's another question here, Guy, from Alyssa, who asks, is it still worth making a non-concessional contribution at this time, or a contribution that brings you to the $25,000 cap? Or is it worthwhile keeping the money outside of super and waiting to see how things pan out?
Yeah, that's a good question. I'll answer it in general terms because a lot of that will apply to your own circumstances. But certainly in terms of, first and foremost, building your funds for retirement, if you've still got taxable income this year, and given where we are in the financial year, I'm assuming that most people have worked for the sort of largely the 8 or 9 months up until this crisis began. So taxable income should still be reasonable, which would, for most people, represent an opportunity to look at and consider making a 25,000 or bringing their contribution up to the cap if they can afford to do so. So certainly from a tax deduction point of view, that may be something to consider. But then also from once those funds are then invested, certainly assets are significantly cheaper than where they were 5 or 6 weeks ago. So you'd assume that you are buying assets cheaper than where they were. It's just a matter of, are things going to go further south before the recovery comes? And that's really going to apply to your risk appetite and also your time frame.
Great. Guy, Karen's asking whether or not it's appropriate to rebalance the portfolio at this time as the economy recovers.
Yeah, that's interesting. I mean, anecdotally, what we're seeing in our client base, we've got more queries on that side being, and I'm assuming you're taking more of a, instead of moving to cash, you're taking more of an approach of, do I move more to an aggressive, more equity or property sort of orientated approach that may recover quicker out of this? And certainly that's something that we're seeing and hearing a lot more of in our space. But again, it's very difficult to say as a blanket statement to everyone as to whether that's going to be suitable to you. It's going to depend on your fund balance, your time frame, and your appetite for risk.
Good. Similar vein, Guy, and probably similar answer. We've got a number of questions popping up about whether it's appropriate to start buying equities at the moment.
Look, I think that it's certainly the time to be thinking about a strategy, but it's more, rather than actually going out and buying something today or tomorrow, no one's 100% certain as to where we are at whether we're at the bottom or not. It's more about, for us, looking at it and having the conversation now and setting a disciplined strategy and approach. And that's more so is making sure you've got things set up in the right matter. So that might be making sure you've got things in the right entity going forward, not buying things in the wrong entity and having to incur the capital gains or the potential costs of moving things later. But then also it's about not just all exit once. It might be more of a dollar cost average or investment strategy that is progressive over a longer period of time. That way you're buying parcels at various points throughout the next, whether it's 3 months, 6 months or 12 months or longer, you can have a strategy that's suitable to yourself to know that you're getting into the market through this rocky time.
Okay, and one more question, Guy, from Kate. And Kate's asking, would the next few weeks or months be the time to adjust one's previous financial strategy from paying off your principal place of residence to putting money into, say, EFTs and the like?
Yeah, that's a conversation that we get no matter what the markets are doing. So the factors there that should be considered are really around, so in your principal place of residence, paying off debt, which if it's your principal place of residence is going to be non-deductible debt. So that is effectively a risk-free strategy that you're saving the future interest cost on that. So given what's happened in the last month with interest rates in Australia now moved to 0.25, 25 basis points, we've seen a number of lenders pass on those rate cuts in full, that we're seeing the lowest lending or borrowing rates that we've seen in the history of Australia. And so it really then depends on, are you happy with, say it's a 3.5%, or sorry, maybe it'd be a lot much lower than that at the moment, I'm assuming with these recent rate cuts, but sub 3% interest rate on your mortgage, that's likely to be better than what you'd get if you're just investing in cash and putting it in a bank account or term deposit. So you have to then move to more risky assets to get a better return than just paying off your home mortgage. And obviously with that comes a lot of volatility and uncertainty as to what the outcome is. So again, that's going to be dependent on where you sit in a number of different factors. And that's certainly something that we can help with on a one-to-one basis.
Great. Here's a question from Marilyn for me. Marilyn's asking, is it still compulsory for me to pay myself 2% of the value of my super fund as a pension before 30 June 2020? And the second part of the question is, will pressure be put on the federal government to reduce this to zero this financial year or the next financial year, as this will avoid unnecessary capital losses where a person doesn't need the payment? Marilyn, the answer is yes. At this stage, it is still compulsory for you to draw the new reduced minimum, in your case, 2%. The industry bodies are putting pressure on the government to look at further reductions and further relief around pension requirements. From what I gather in talking to those industry bodies, I don't think that the government will entertain a further reduction. What you can do though is talk to your advisor about looking at whether it's appropriate to turn off your pension or commute, is what it's known as, commute part of your pension back to accumulation phase to avoid you having to take out that 2% minimum. It's really important though that that if you do nothing, that you ensure at least you take out that minimum 2% or whatever the case may be for an individual, and make sure that comes out before 30 June and allow at least a week or so for the bank clearing times, and make sure it's exited your super fund and into your own personal account before the stroke of 30 June. I didn't have any other questions other than they're all of a very similar theme. Around the rent freeze, again, that will be an application process from the tenant. If it's a related party tenant, that's the biggest area for a self-managed super fund, and making sure that the trustee and the tenant, which generally will be the same person or related party, that process is documented and the considerations of both the tenant and the landlord have been substantiated. And remember, it's not a free kick for everyone. You really will need to be able to come to the party come the time of lodging your tax return for 2020 and being able to evidence exactly how you decided and determined to issue that temporary freeze on rent if that's where you land. Where you've got a non-related party tenant, that's potentially a bit easier because you'll be dealing with each other on an arm's length basis anyway, and normal commercial arrangements will apply, and you may well find that your tenants are going to come to you, and even if they are non-arm's length, and look at a rent reduction. What that means is that you'll go through the normal rigors of what you would in a normal rent review cycle. We also have a number of clients, and I didn't get it to my slides, where they have a limited recourse borrowing arrangement that holds a property under their super fund. And there's two scenarios there. We're seeing some banks already reaching out to clients where they have a limited recourse borrowing arrangement and offering them an interest-free period. So that's not necessarily dialing the interest right off, but giving it a kick down the road until things recover. But then the one of more interest, I guess, from my point of view, is where we have a related party lender. And I think the ATO's attitude will be very similar to what we've seen with, in terms of issuing the rent reduction for a related party tenant. Where you've got a related party lender, you'll need to be able to evidence what other lenders within the market are doing. So you simply would be ill-advised to just turn off your loan repayments if you're a related party lender, without, again, putting some rigor around your documents and referencing the market and making sure that you're treating your related party borrower no differently than what an institutional bank would treat you, and documenting that up front.
And just from a market point of view, I thought I'd just give a quick sort of overview as to the things that we'll be looking at in the coming weeks and months ahead. I think it's important that everyone remembers that share markets are really looking forward. They're sort of looking out 6 to 12 months and trying to price in what the impact to various companies are going to be. So the things that we'll be looking at will be things like earnings. What sort of, there'll be a vast difference between companies as to what their situation looks like. On one hand, you've got things like Virgin that went into this in a relatively weak financial position, and I think is seen earlier today is already looking for bailout measures there. And then you've got other companies sort of going into this, and like Coles and Woolworths, where they've been inundated with people buying and bringing forward grocery shops and hoarding things, which will be interesting to see how that unfolds as well. So earnings will be a big part of what we'll be watching. Obviously, the unemployment figures will be a really substantial part. Those figures are just going to look horrible in the near term. We've already seen large parts of the economy shut down where people have been laid off left, right, and centre. The latest package that was announced yesterday, I think, is a great initiative, which hopefully just keeps those employees in sort of hibernation and ready to go once we get through the worst of this. The next part is then looking at dividends. If companies are going to take a hit to earnings, it's likely that we're going to see a pullback on dividends and distributions, and some so obviously because they're going to have an impact to revenues, but also some just because of the uncertainty that's out there, they might be holding back and holding on to some cash going through this. The opportunity that might arise is some companies may need to be, or they'll be forced into a position where they need to restructure from a capital point of view. So we may see some corporate actions there where we're seeing businesses come back to market and look to raise money at cheaper prices. So people with cash and the aggressive attitude to be able to take up those opportunities may be rewarded in the longer term. I think as a high level overview, it's really going to come down to the infection rates and spread, and then that's going to dictate what the policy responses are and how long we're in this. The other sector that is a really interesting one to be keeping an eye on at the moment is what's happening in oil prices. Oil, obviously demand slowed down early in the piece with China going into lockdown at the very start. But what then exacerbated the problem there was OPEC or OPEC Plus, including Russia, met and basically made the decision, no, we're not going to reduce supply, we're going to continue producing, which has meant that oil prices per barrel have now dropped to somewhere around the $20 a barrel, which is, should be a good long-term thing. Oil prices are cheap, but no one's certainly going anywhere, or no one's flying or traveling or doing anything. So the things we'll be looking for there is hopefully some sort of deal between OPEC and Trump and Russia that they can come together and work out that supply issue that's happening. From the bigger picture outlook, it's, as I said before, the medical breakthroughs. It's really about some sort of longer term antivirals or vaccine. That's some way off. It's the policy responses in the short term, and that's what we're seeing a significant amount of over the last few weeks. I'd expect that there's probably going to be smaller things, because as they announce these things, they find there's other knock-on effects that they need to quickly go and make sure that they fill the gap on that. And then, once we see some confidence in terms of the numbers and that the healthcare systems are coping, that's when, as we're starting to see some positive news out of Wuhan with less infection rates or no infection rates, then we're starting to see signs where there's more people getting back out there. They're taking those lockdown measures off. And some people are looking at those figures and saying, well, how can we know what numbers are there and what's happening? Anecdotally speaking to some fund managers, they've been using things like live traffic cams to look at what the traffic looks like on some of those main roads in China, and they are seeing an increase in people slowly getting back out there and the economy starting to tick over again. So there is some positive signs. It's just a matter of being in the right place and having the right strategy to work through this.
I think you're right, Guy. It's a long-term strategy, isn't it? And making sure you've got the right advice. And while it's tempting to make a knee-jerk reaction, it could have some long-term impacts for your financial security.
Yeah, most definitely. I think humanity, there will be positives that come out of this. It's certainly going to change the way that we do everything from a health and social point of view to a financial and economic point of view as well. So I hope that we all focus on some of those positives and go through with the things that we actually want to sort of focus on going forward. We can learn from it.
Great. We're just 5 minutes before 4 o'clock here in Brisbane. So I'm mindful that everyone's got a busy day ahead. Just a reminder once again that this webinar is being recorded and will be distributed to your inbox within the next 24 hours. Mark Molesworth, our tax partner, will be providing a webinar and some deep insight into the legislation and how that applies on Friday morning, I believe. So keep an eye out for that. Thank you everyone for joining. Have a great evening. Stay safe, stay well, and stay apart.
Thank you all.